And then, in fact, Maureen going to talk about this a little bit, but let me start by saying right now, inflation is at a historical high in the past 40 years, highest inflation. Now, the government official estimation of the inflation is, I think the last time I checked recently, was around 8.5% inflation rate. But you and I know, right? If you go shopping for groceries, for airline tickets, or for eating out, whatever, the inflation rate is way more than 8.5%. And some people may argue it's at 12 to 15% even. Now, one thing I'm going to say that a lot of you out there may not have heard, but you may have heard from the first time, and Maureen can talk about it momentarily. Think about it. If the official rate of inflation right now is 8.5%, and if you buy an investment property and you pay a 30-year fixed rate mortgage of 5.5 to 6%, look at the disparity. What does this mean? I'll say it again before Maureen will chime in. Today's official inflation rate is 8.5%, and the mortgage interest rate you're paying is 5.5 to 6%. What does that mean to you as a real estate investor? So with that in mind, Maureen, take it away. What is your perspective on this?
Well, thank you. So, gosh, you've got lots of good slides here, really good data, and you and I are on the same wavelength here without even conferring before this phone call or before this Zoom call. So, yes, what that means for those investors that are listening is that while the inflationary rate remains higher than the interest rate on borrowed money, you are essentially being paid to borrow. You are earning on the borrowing side. So think about it this way. You lock in for, and I want to rewind just a little bit. So when you showed the slide, Seewing, of the historical interest rates dating back to the 1980s, we are historically low. But we have been, a lot of us investors have been very spoiled. We've been very spoiled because we have, we've had interest rates below 5% and many times below 4%. So when you can lock in, and many of these listeners probably have refinanced their primaries into rates of 2%, right? So when you get the benefit of taking borrowed money and locking it in for a fixed payment over a fixed period of time, that is beneficial to you. As investors, when we do the same thing, we take that borrowed money, fixed payment over a fixed rate period of time, and then you add in depreciation of the asset, increases in rent. Of course, you get the depreciation each year on your tax schedule. You get the hedge against inflation, which is what we really need to talk about here. When you add those benefits all together, real estate has been a tried and true and very inflation-proof asset. So a lot of, I will say this from selling turnkey rental properties for the last 13 years, is we've always just shouted from the rooftops, cash flow, cash flow, cash flow, cash flow, cash flow. You invest for cash flow. That has been true and still remains true, but we have to look at what has changed here recently. And it all started in March of 2020 when the printing presses for money went nuts. 40% of the current monetary units in circulation today have been printed since March of 2020. In 2 years, 40% of the money supply in the United States has been printed in 2 years. The true definition of inflation is not the CPI, right? Because the CPI is, in my opinion, it is a manipulated metric to make things look better than they are from a government's perspective. They basically take, here's a basket of goods, they cherry pick what they put in that basket, and they say, okay, this is what the consumer price index is, and that's what the inflationary rate is based off of. Now, I don't know about you, Seewing, but I think your basket of goods and my basket of goods and your neighbors and our friends and family, everyone has a different basket of goods. There's some overlap, but you're not getting your nails done and your toes done, right? You're not going and getting your hair colored every 2 weeks like I am, right? So there's differences in that metric, and it's very manipulated by the US government. So the true definition of inflation, if you actually look it up and you go to a dictionary from 20 years ago and you look up Webster's Dictionary of Inflation, it will tell you that inflation is a change in the money supply. What has the government, our US government, not only US, what have many other countries and their governments have done? They've just printed more money. So now we find ourselves in this situation as investors, and we have to figure out where is the best place to place our capital right now in a highly inflationary state, which looks like it's going to continue. And you make a very, very good point. If inflation is at, as the government reports, which we take that with 100% accuracy, at 8.5%, and you're borrowing money at 6%, let's call it, you are essentially getting paid to borrow money. Now, guess what? Here's even a beautiful, better thing, right? If you're paying, let's say you're paying 6%. I'll even go a little higher and say you're paying 7% by the end of the year, right, for borrowed money. When you factor in the depreciation benefit that you get, it's really like paying 5% money, right? But we've all been so spoiled for the last 10 years of paying under 5% that people are freaking out. The fundamentals do not change. The fundamentals are you so the fundamentals don't change, which is buy appreciating assets that cash flow and reduce your tax liability. That is the formula for building wealth. Slow and steady wins the race. Real estate has been tried and true for centuries. This is not just, our little short timeline here on earth that we're saying this works. It has been proven long before we even arrived here on this planet. So the fundamentals do not change. What has changed and where we have to pivot in our thinking as investors is the days of buying a $150,000 house that's going to cash flow $300 to $500 a month does not exist today, right? What does exist today are renovated properties, brand new construction, where you can buy for under $200,000 in, actually I would say most of my properties are under 200,000, but my new construction goes from 230 to 250. So let's call it under 300,000. You can still buy a brand new house, a renovated house, lock it in at a rate less than inflation. And it's an asset that appreciates along with inflation. When you add in the rent escalation over that fixed rate period of time, right? Your mortgage payment never changes for that 30 years. And most real estate investors, they hold their rental properties from anywhere from 5 to 30 years. During that time period, you are going to have rent escalation over that time period coupled with the appreciation of the asset. Now, Seewing mentioned that there are various groups, housing analysts, investment strategists that forecast what the capital appreciation, home equity, will be in the coming years. And it's based off of just basic economics, supply and demand. We don't have enough supply, there's a very high demand. Are we going to see the record double-digit capital appreciation? I use capital appreciation and equity interchangeably, if anyone's getting confused. We've seen exceptional capital appreciation over the last 224 months. We probably won't see that same double-digit, but we're still going to see incrementally year after year until we capital appreciation increases until we get to the equilibrium that Seewing was talking about. So let's just say you guys have I'm going to use one to cheat, use my calculator, right? So let's say you guys, you invest in a $200,000 house today, you finance at 6%. And maybe you don't get the $250 a month cash flow, maybe you get $100 cash flow. But that's after all the expenses are paid, it still does cash flow, right? And the formula for building wealth is buy appreciating assets that cash flow and reduce your tax liability. So it still works. Even in a higher interest rate environment, it still works. So you take that $200,000 property, and let's just say, I'll go with Pulsenomics' recent forecast for housing value appreciation of 9%. So I'll take that $200,000 property and multiply it by 9%. That comes out to $18,000. If you had multiplied that by 5 properties, right? That's almost $100,000 that shows up just by you holding the asset that is a high value asset because it is a scarce asset at the moment, right? So lots of bullet points there, Seewing, that I just sort of unraveled. But I think what you were really asking me is, what is the benefit to investors today in investing in hard assets like real estate? And many investors are looking, we're all, I mean, myself included, we're searching. It's like, you know, I've got money in the stock market, and I've seen a pretty significant reduction, right? In that, because I'm an aggressive investor. So I saw a significant reduction in my portfolio. Worrisome, but luckily I've got a lot of properties that I own. So when investors are looking at this particular moment in time, in July of 2022, and they're looking at, what do I do for the next 6 months, for the next year? Where do I put my money? Because the market is very volatile. Crypto is very volatile. Bond market is very volatile. Where can I put my money in a place that is a good hedge against inflation, or an inflation proof that will still produce cash flow and reduce my tax liability, even if I'm paying a little bit more for the borrowing cost to buy that asset, it's still well below inflation. And so there's definitely a benefit, a real significant benefit for us as real estate investors.
Very well said, Maureen. As a matter of fact, in the latter part of our presentation, we're going to break down those data you just mentioned. We can talk about on a numerical basis. I'm going to show some graph of all those numbers, and you'll see it. You know, your verbal presentation will be validated by my graph, and the numbers will show. And so, you know, it'll come together for a lot of you out there that are listening to this very important, highly educational presentation. So thank you for your nice recap. So keep your thought. Let me continue my presentation, and yeah, a lot of things. All right. Okay, now let's quickly go over a couple of things. Again, for risk investors, for long-term risk investors, in the past, who knows, in the past 60, 70, 100 years, if you invest for the long term, right, in buying real estate, you will make money. Your property will increase in value. There's only one exception in the past century that real estate prices had gone down, and that was in the 2008 real estate market crash, right? As you can see the graph, right? So, you know, it's so simple. You know, I mean, what is there to fear, right? Than to fear itself. If you invest for long term, over the past almost 100 years, only one time the real estate has crashed back in 2008, and only the reason that happened was because of the subprime mortgages, because there were oversupply of homes. Anybody can qualify to buy properties and all that scenario. And by the way, that's a subject for another video presentation. But in today's real estate world, we're not seeing any of those trends that caused the 2008 market to crash. So just take that with a grain of salt, right? So today is a whole different market. I mean, and this slide shows over the many decades, even through recessions, again, with the sole exception of 2008 crash, real estate has maintained value throughout all the various recessionary cycles over time. So just go to show you, real estate is very resilient. All right, so as a real estate investor, I could make the argument, and Maureen as well, is right now, I'm not talking about tomorrow, next week, or next waiting. The cost of waiting will be very catastrophic for real estate investors. Right now, I truly believe what I will, and Maureen as well, and that is the best time to buy real estate, best time to invest in real estate, because it's a renter's nation. Like, as I said earlier, not only does the real estate prices have skyrocketed in the past couple of years, and even in the past 10 years for that matter, but the rental increases, this single digit, double digit, triple digit rental rate increases is coming. You're not seeing the impact of the rising rent yet, because the rental increases lag behind the rental appreciation rates. All right, Maureen, I'm sure if you want to chime in, you can. But right now, the pro forma I'm about to show you momentarily may not reflect that. But get in the game, buy your properties at your earliest convenience. Then in the next year, next quarter, or later this year to early next year, whether you have the same tenant they're occupying your property or not, or you can have a next tenant in, that the skyrocketing rent will reflect on your property, right? You can raise the rent for 10, 50%, whatever, depending on what neighborhood, what market you're buying. I'm not saying all the market are the same, but as a landlord, as a risk investor, this inflationary period that we're facing right now, with all those challenges that we're facing, is really good for the risk investors, because inflationary times, you're getting rental rates rising because people are renting these days, right? Today's a renter's nation. I mean, we're not going to sugarcoat it. Right now, moving forward for next several decades, I believe that there will be more renters than ever in the history of the modern U.S. Economy. There are more renters than ever. So people, there are some market where you're seeing 40 to 60 rental applications per house that are marketed for rent. Just go to show you. Before, you hear the buzz war, bidding war for buying houses in the past couple of years. Now, now you can hear bidding war for renting your houses. So that bodes well for real estate investors. Your cap rate, your rental income, your cash flow will increase starting very, very soon. May not be now, like I said. So just keep that in mind, okay? All right. So any quick comment, Maureen, you have before we'll go over a case study?
Yeah, no, that was a really great point. The beautiful thing about owning rental properties is you as the landlord can control the rent increases, right? So you can hedge. Not only you're hedging your bet against inflation with the capital appreciation in the property, but you have control over what you increase your rent by year over year. And each time, I mean, renters are expectant of that. If you're in a year lease, the expectation is that lease is going to go up a certain percentage each year. So when you are in high inflationary times, you're looking for ways to beat inflation and still get the cash flow. You want to have more control, and being a landlord and being able to increase the rent gives you that control.
Yeah, Maureen, you and I agree. Not only new investors buying your rental properties moving forward right now, but on my own personal real estate portfolio, and I'm sure on yours, Maureen, as well, and many of our past real estate investors that purchased 5, 10, 15 years ago, you know what they told me? They are increasing their rents. They are getting more cash flow than they have in the past. So their cap rates on their homes, rental homes, is like a 6, 7, 8% cap rate, very high cash flow. So the cash flow will come slowly but steady in the next few years. Right now, you may not experience it, but you will very, very soon.